Good morning, real ECN listeners. This is your Forex market commentary brought to you by real ECN. Today is Thursday, January 2014. In line with today's discussion, we're going to discuss and break down the FOMC meeting and how it plays out on the euro-dollar market. The euro-dollar pair is the most popular traded currency pair and quite often it's dubbed as the risk trade. So if you're holding this position or you're trading this position, I hope this commentary can provide you with some insights into formulating your trading strategy moving forward. So in line with our discussion, first of all, we're going to talk about the technical front on the euro-dollar market. The analysis of a collection of technical indicators on the hourly interval on the euro-dollar market suggests a temporary bullish market sentiment and recommends short positions on the greenback. The hourly chart established a short-term Fibonacci resistance at 1.3675 and Fibonacci support at 1.3639. The euro-dollar cross began this week trading session above the 200-day simple moving averages. This trend holds great significance as 200-day simple moving averages contain more or less of 1 year worth of trading data, and it forecasts long-term market sentiments, and currently the peers are trading above, and if it continues to trade above the 200-day simple moving averages, which is indicative of a long-term bullish market sentiment outlook on the peers going forward. This bullish market sentiment is also validated by the euro-dollar pair opening today's Sydney trading session above the 5, 10, 20 and 30-day short-term simple moving averages, which is indicative of a buy recommendation on the technical front. Since 24th of January, the euro-dollar market has been trading in a low narrow congestion range mapped out by the compression in the Bollinger Band. Bollinger compression often foresee near-term breakouts. This is quite often an indication of low volatility and volume, particularly could be attributed to investors shying away from volatility associated with market risks such as the FOMC meeting taking place right now in Washington, D.C. The Fed's announcement of tapering at a pace of $10 billion to its $75 billion a month of QE program down to $65 billion a month failed to stir any strong reaction in the euro-dollar market. Since this particular tapering action is largely in line with market's consensus, investors have already priced in their expectation weeks in advance. Traders are now waiting for the European and New York market to commence to see whether the large liquidity and participation associated with these markets can gather enough momentum for the pair to break out from this congestion. One possible reason to why the euro failed to react to the downside upon the release of the upbeat Fed tapering announcement could be attributed to the positive German consumer climate reading of 8.2, beating forecasts of a 7.6 reading. So now it's time to have a close look at our indicators. So according to the hourly time interval, our indicators, first in line we have the RSI. It has a price reading of 51.82 with technical recommendation of a neutral. So that is in line with expectation because looking at the graph, it is trading in that congestion range. So the momentum is relatively weak and it's sitting at neutral right now. Moving down several notches, we have the CCI, which is a commodity channel index. It indicates a buy or sell signal. Right now it has a price reading of minus 8.0571 with technical recommendation of a neutral. Lastly, we're just going to touch on the bull and bear power ratio. It has a price value of minus 0.004, which is relatively weak, but yet the bear has the upper hand with technical recommendation of a sell. So overall, we have 4 buys, 3 sells, and 3 neutral, and the buy indicators just win by a small margin with technical consensus, overall technical consensus of a buy, which is still relatively weak. Of course, any trader would know that technical indicator is one component of establishing a trade. You also need to focus on the fundamentals, which we're going to talk about right now. If your fundamental is in line with your technical, then it validates your trade. So first of all, the euro-dollar pair is widely associated with the market sentiment towards risk. When risk appetite is strong, this often proves bullish for the pair. However, the pair can also be driven by concern over emerging market, which have some speculated calling it the 1997 style emerging market currency crisis. The risk and fear element in emerging market are once again elevated when Turkey's central bank raises their benchmark rate by 426 basis points, more than what the market have anticipated. This action was intended to slow down the depreciation of the local currency amid a time where capital outflow out of emerging market are gathering tractions. In line with raising rate in emerging market, South Africa also raises their main refinancing rate by 50 basis points. The prevailing concern is whether this risk flight out of emerging market is enough to trigger a full-scale risk aversion trade, by which it can prove to be detrimental to the euro. Over in Washington, D.C., the spotlight was placed over the FOMC meeting. Despite the recent disappointing U.S. non-farm payroll number, the Federal Open Market Committee collectively voted on the tapering of its $75 billion a month on mortgage-backed security purchases, as well as U.S. long-term Treasury by a rate of $10 billion. Since the Federal Reserve stepped into the role of becoming the main U.S. liquidity provider during the 2008 financial crisis, the instigation of its quantitative easing program has the Fed balance sheet swelling up to $4.1 trillion. A far cry from any immediate rate hike, the U.S. benchmark interest rate remained at 0.25%. The announcements of this tapering seem to have very little impact on the euro-dollar price action, only the greenback edging a little bit higher on safe haven piling by investor, causing the 10-year Treasury yield to drop by 7.1 basis point to 2.677%. Since the market is very forward-looking, there are several risk events for the remaining of the week that investors are keeping an eye out as cues for near-term euro-dollar price swing. These include Germany's unemployment rate forecast reading of -5K. Also, investors are paying close attention to the Spanish GDP release quarter-on-quarter forecast of 0.3%. This can act as a thermometer for expectation of the ECB decision towards accommodative easing policy. US GDP quarter-on-quarter is expected to expand at a rate of 3.2%. This number plays an important role in highlighting the US robust recovery story. Along with that is the US pending home sale number, expecting to tick up higher at 0.3% from prior reading of 0.2%. Wrapping up the week, the market can expect core Eurozone CPI number at 0.8%, as well as the the official unemployment rate expected to remain high at 12.1%.